Twitter, and the handle is @PeterSwitzer. One of the government's current economic embarrassments might be their failure to produce a budget surplus. And the Coalition's Shadow Finance Minister, Andrew Robb, has pondered what excuse Finance Minister Penny Wong will have to dream up to explain it. Mr Robb joins us to evaluate the future of the government's budget surplus. Andrew, thanks for joining us.
My pleasure, Peter.
Now, I know you would love the government to be creating a budget surplus because you're a man who loves economic responsibility, but you don't think it's going to happen, do you?
I don't for 1 second. I mean, I see, to be honest, no viable plan to do anything about their current situation. Just look at what's happened. They've spent now $173 billion more than they've raised in revenue. They've had the 4 biggest deficits in our history. They've got a debt now over $250 billion in gross terms, and they've got $120 billion of promises that are unfunded. How can anyone believe that anything's going to change? And in fact, some of the independent commentators, many of whom are former Treasury officials, are now starting to bell the cat and say that there are inbuilt government structural deficits of the order of $20 to $25 billion a year for the next 4 or 5 years. So, there's no joy on the horizon, and if we do get the privilege of government, I think we've got some hard times ahead. Well,
so what's the excuse you think Penny Wong is going to come up with? Is she going to say, well, this is all happening because the economy's not growing fast enough, and could she blame the Reserve Bank for that?
Well, look, all they are really interested in is getting through the next election. So I think they will continue what I believe to be a sort of calculated deception. If you go back 2 years before the last election, they put out forecasts from revenue which were just beyond the pale, ridiculous. Everyone knew they were too ambitious, but it enabled them to say they'd be in a surplus by 12-13, enabled them to say we won't have a net debt getting above $94 billion. But of course, it's only 2 years since, and we've had, since then, 2 of the biggest deficits in our history, and we've got a situation where the net debt is now at $150 billion, and some sources saying it will go to $214 billion within the next 3 or 4 years.
But really, Andrew, the most important thing for them is, do they actually crack the surplus for this year? Because, as you know and I know, they've talked about being a test, in a sense, for their economic credibility. Do you think that they might go to an early election to avoid the embarrassment of actually having to fess up to not actually cracking the surplus?
Well, firstly, they won't go to an election unless they felt that they were in a position to win the election. And, if things don't change dramatically, they won't be going before the next budget in that sense. So that's a big issue you've got to consider. Secondly, they have started to walk away from the surplus in the Parliament. They've started now to say they're confident about the forecast, but they'll no longer guarantee a surplus. They're playing with words again, as they are very clever at playing with words. I mean, that's their forte, really. I think what they'll do is say that unforeseen circumstances outside of their control have meant that they won't get to the surplus, despite all the money shuffling that they've done. They've literally pushed nearly $12 billion out of the 12-13 year, which should be in there. So really there's a deficit of some $12 billion to start with. But secondly, they will make forecasts again that suggest that, the next year will be achievable, or the year after. Now, this has been their technique endlessly to predict, rosy forecasts and prudent spending, and then when that doesn't occur, they explain it away by events overseas, and they'll try that trick again, but I think that's wearing thin with the population.
Andrew, do you argue that what they did when the GFC hit, in increasing spending and effectively keeping unemployment under 6%, which was a shock to even a lot of economists in this country, do you think that was wrong?
I do. I think what has been greatly underestimated was the power at the time, not only of inheriting an economy which was in much better shape than all of the other developed world, and with no debt, in fact $70 billion of net assets. Not only did they have that as a sort of bulwark, but also the automatic stabilisers. You might recall, Peter, that the first quarter of 2009 we had the biggest trade surplus in our history because the dollar dropped to 60 cents, and at the same time interest rates came off 3.5%. Those two factors alone really restored enormous liquidity into our market, put a lot of money in people's pockets, and a lot of the spending came really in the year or two after that. It was almost too much after the event, and the quality of that spending was appalling. So I think they grossly overspent, something in the order of 60 billion overspent. Now that has put pressure on interest rates ever since. It's kept the dollar up. That's why manufacturing's struggling. The government has made a big contribution to a lot of the problems outside of the resource sector because of that wanton spending and the continued deficits. Macroeconomics, headed by a former Treasury forecaster, said that really if they had not spent like drunken sailors, we would be in surplus last year by $15 billion. So, you know, I do think a lot of the problems that we've faced and challenges have been of the fact that they have spent as though there's no tomorrow. And as I said at the outset, they have still spent today $172 billion more than they've raised in the 5 years that they've been in office. Talk about fiscal discipline.
So if you were given the privilege to control the reins of finance in this country, would you cut back spending pretty substantially? And if so, by how much? And what would be the key targeted areas?
Well, we've still got the books open because we're still potentially nearly 12 months from an election. For a government like this, given, you know, some of the disasters that they've perpetrated, 12 months is a long time. And I just make one observation. You know, in the last month we've had 2,100 people arrive by boat. Now every boat is another $13 million. If that is repeated for the next 11 months, that means an extra 25,000 boat people. Now that will blow the budget out without anything else by several $billions over and above what they're forecasting will be spent in that area alone, right? So we can't close our books until much, much closer to the election when we really know the situation. Anyway, once that happens, we've got to make the assessment. We will live within our means. We have set ourselves a principle, cast iron principle, that we will as a government live within our means. That will mean cuts in programs. What the size is, we're not sure yet, but I'll just make the point, it's not just cutting government expenditure, there's much what else you do. It's the quality of the spend is also very important. You know, the pink bats issue, that cost billions of dollars, overran by billions of dollars, but it actually cost a lot of very legitimate businesses their business because of the way they mismanaged that spend. Now that's happened in so many different cases. So we have, you know, that's why the Commission of Audit that we talk about, first thing we'll do, Commission of Audit, you know, along with removing the carbon tax and the mining tax, that Commission of Audit will help us identify a lot of areas where the quality of spend, adding up to tens of billions of dollars, I think, in many cases, can possibly be tackled by ourselves.
The thing that worries me, Andrew, is the carbon tax, which clearly has negative implications on numerous, particularly small businesses around the country. You don't know what kind of cost will be involved in unravelling the carbon tax. So you might actually end up with a surprise big bill, and actually that could stifle some of the cutbacks you make in other areas.
Well, look, we have done a lot of work on this. The carbon tax was introduced with a piece of legislation, and it can be removed with a piece of legislation. They haven't moved to a trading situation. That's not for another couple of years. So there isn't the issue, you know, of those long-term liabilities and any potential compensation. It's simply a new tax has been brought in and we can remove a new tax. It will remove costs immediately across the board and very significantly. They've said a 10% increase in costs from the carbon tax. We should see a comparable downward pressure on prices as a consequence of removing that carbon tax. Now, what sort of good start would that be to confidence? Because there's a crisis of confidence in this country at the moment, not just because they've introduced or increased 27 taxes, but because they keep changing the rules. If some adults can take over and start to make decisions in a measured, stable way, and when we do take decisions, insist and ensure that they last, you know, for 5 years or so, that people can get a return on that risk investment without the prospect of rules changing midstream. The sovereign risk issue is just killing this country, killing investment. There's a lot of money on balance sheets, as you would well know, Peter. There's a lot of money on balance sheets around this country, but companies saying to me time and time again, we're not going to invest until we got some certainty that the rules are not going to change, and that means until an election occurs.
OK, now what about the fact, you mentioned debt earlier. It's about 10% of GDP right now. What was it when they took over? And how serious do you reckon 10% of GDP is?
Well, it was much lower. I mean, Wayne Swan was saying, you know, 6 or 7%. Well, there was no debt when they took over, right? So we had $70 billion of net assets when they took over. So we were a country free of debt. And can you believe now we're back at $250 billion gross debt, and that's 10%. But if you add the state debt on top of it, and of course, you know, if we had a whole lot of Labor administration, $85 billion alone in Queensland, and you add the state debt, we're up over or around 20% of GDP. And the thing is, I know when I ran a business, the first 20 or 30% you can control the level of debt. After that, the debt starts to control you. And, you know, you look at someone like macroeconomics, one of the independent forecasters, they're saying that net debt could well, or gross debt, could well go well over their $300 billion ceiling, and as a consequence, we're starting to get into, you know, more dangerous and vulnerable territory with the level of our debt. It's prudent, as any family will tell you, and any company will tell you, you've got to keep debt at a manageable level, and the way this government is spending and growing that debt, Swan was just 2 years ago saying 6% is a good figure. Now he's saying 10% is a good figure. You know, Where's it going to finish with this fellow?
Andrew, thanks for joining us on the program.
My pleasure. Thanks, Peter.
And now we're